Welcome to this webcast about Dynamic Risk Management Project. My name is Ziki Ni, and joining me today is Matthias Schuler. We are both members of the IASB technical staff. This webcast is the first out of two webcasts following our initial webcast theory in October 2022 about the DRM model. This follow-up webcast focused on the determination of the current net open risk position, which we will refer to as a CNOP later. Specifically, it further explains the recent tentative decisions of the IASB in relation to the items eligible for inclusion in the CNOP, in particular, an entity's own equity, financial assets measured at fair value through profit or loss, and financial assets measured at fair value through other comprehensive income.
During the whole time the DRM project has been active, the IASB has received a large amount of feedback, commenting that equity is commonly considered in an entity's dynamic risk management activities. Typically, an entity is in a net asset position, with equity being the residual. For a bank, this means that some equity is used as a source of funding for interest-generating financial assets that the bank originated as part of its main business activities. When entities include equity in their dynamic interest rate risk management, it is usually with the main objective of stabilizing and/or reducing volatility in net interest income. In practice, they therefore treat the equity as a deemed fixed-rate liability. However, the economic reality is that equity in itself typically does not have a direct exposure to changes in interest rates. Equity does not give rise to variability in an entity's NII. Any distribution of dividends or repayment of capital is recognized in the statement of changes in equity. In fact, any variability in NII stems from the excess of variable rate financial assets over variable rate financial liabilities, rather than the use of equity. Therefore, instead of creating a proxy to determine a risk position, that is modeling equity as a fixed rate liability, the DRM model would take a more direct view and focus on the excess portion when determining the CNOP. As a result, we are of the opinion that an entity is still able to reflect the effects of their risk management strategy and activities without the use of equity, as the interest rate risk can still be faithfully portrayed in the CNOP by adopting the direct view of including financial assets and financial liabilities. Therefore, the IASB tentatively decided that equity is not an eligible item for the purpose of determining the CNOP in the DRM model.
To achieve the faithful reflection of interest rate risks in the CNOP, the IASB reconsidered another tentative decision it had taken during the development of the core model, that is, notional alignment of what was then called the asset and the target profile. This requirement was meant to avoid leverage in the target profile of the DRM core model, which synthetically creates risk positions that does not exist organically. To prevent such a situation, the IASB at the time tentatively decided that the notionals of the designated financial assets and the financial liabilities in the DRM model must be the same. Reflecting the economic reality, however, an entity's balance sheet position will typically be in a net asset position, with the residual being equity, and therefore it is likely to display notional misalignment of designated financial assets and financial liabilities. When notional alignment does not happen naturally, any adjustment to meet the requirement would have to be done on an arbitrary basis and therefore would not faithfully reflect an entity's actual organic interest rate risk exposures. This would be inconsistent with the objective of the DRM model, and therefore the IASB tentatively decided to no longer require the notionals of the financial assets and financial liabilities designated in the DRM model to be the same.
Consequently, despite the tentative decision to exclude equity, the entities can nevertheless include the eligible interest rate risk managed financial assets and financial liabilities into the DRM model, and thus faithfully represent the effect of their interest rate risk management strategy when the intention is to stabilize net interest income. When there is a notional misalignment, depending on the type of excess exposure, i.e. whether it is fixed or variable, an entity's risk management strategy would determine which risk metric, for example, delta NII or delta EVE, takes precedent at a particular risk point. It will therefore be reflected through risk limits which define the extent of the compromise or trade-off between conflicting risk matrices. Considering the tentative decisions on equity and notional alignment together, we are of the view that an entity would be able to provide direct and transparent information about the extent of interest rate risk exposure it tries to manage in the DRM model, which is relevant and faithfully represents the cause of any variability in economic value or net interest income. While this might appear on the face of it to be divergent from some entities' current practice of, for example, scheduling cash flows to determine a particular risk view or substantiation of assumptions taken to model cash flows, we believe that such changes will in fact improve the availability and usefulness of information for financial reporting purposes.
In February 2023, the IASB further discussed and tentatively decided that when an entity determines a CNOP, financial assets measured at fair value through OCI are eligible for designation in the DRM model, but financial assets measured at fair value through P&L are not. Our analysis of whether to include or exclude these financial assets focused on whether the economic effects of risk management activities executed, that is, the derivative traded to reduce the variability in economic value or earnings, can be faithfully reflected in the financial reporting when including those items. To be clear, the economic effects of the risk management activities of an entity are independent from the accounting. The purpose of the DRM model is to help entities to better reflect such economic effects in financial statements when the general accounting requirements may lead to periodic mismatches in profit or loss account, which could be inconsistent with the actual economic phenomenon. The DRM adjustment is based on the Loroff test, which compares the cumulative change in the fair value of the risk mitigation intention and the cumulative gains or losses of the designated derivatives. It adjusts the timing difference in recognizing the gains or losses on the designated derivatives in accounting. Together with the effect of releasing the DRM adjustment into NRI over time, therefore matching it with the NRI from the underlying designated financial assets and liabilities, the application of the DRM model will faithfully reflect the economic effect of risk management activities in financial reporting. In our staff analysis, we used instrument-by-instrument examples for simplicity, in order to illustrate whether the economic phenomenon can be reflected in financial reporting. However, this can be extended to a portfolio level too. Despite being recognized at fair value on the statement of financial position, financial assets measured at fair value through OCI have the same exposure to interest rate variabilities in profit or loss as financial assets measured at amortized cost. The interest is calculated using the effective interest rate method under both categories. Therefore, applying the DRM model would help reduce the accounting mismatch in the statement of profit or loss between fair value through OCI assets and the designated derivatives. This is different to financial assets measured at fair value through P&L, where the changes in the fair value are recognized in profit or loss immediately, similar to that of a derivative, which would not lead to a mismatch in the statement of profit or loss.
It's worth noting that since the DRM adjustment is a mechanism of delaying the recognition of the derivative in profit and loss, no measurement adjustments on the underlying items are necessary, and hence there is no double counting of the same risk component in the case of financial assets measured at fair value through OCI when posting the DRM adjustment to the statement of financial position. Some stakeholders have said that although the DRM model will reduce the variability in profit and loss, there will still be volatility in other comprehensive income with regard to financial assets measured at fair value through OCI. However, it is worthwhile remembering that the extent of risk being mitigated has no direct link to the underlying items. Therefore, determining any split between what amount of the DRM adjustment would have to go to the statement of financial position or OCI would have been arbitrary and would have significantly increased the complexity of an already complex model. Separating a portion of the DRM adjustment relating to fair value through OCI assets with the aim to reduce volatility in OCI would, in essence, require an entity not only to consider which items are included in the calculation of the CNOP, but also to identify which items made up the interest rate risks actually being mitigated. This would be inconsistent with the fact that entities manage interest rate risk on an aggregated basis across their portfolios holistically. This is why such a solution has not been pursued. We also acknowledge that some fair value through P&L assets might be included in the holistic open risk position from a risk management point of view, as the accounting classification might not be relevant to a risk management view. However, from an accounting point of view, there's no need to include these items in the DRM model. To the contrary, from a majority of those financial assets measured at fair value through P&L, the DRM model would produce results which would not improve information for users. In addition, these specific items would represent a subset of the financial assets measured at fair value through P&L. To just refer to the subset to allow designation in the CNOP, it would require specific requirements that focus on individual items rather than an aggregated view. As a consequence, we believe fair value through P&L items should not be eligible for inclusion in the CNOP.